It doesn't really matter whether you believe it was caused by the sell-off in China or whether or not it's a case of South Africa falling off its own cliff, or maybe it was the Fed that hasn't been clear on interest rates. What on earth has caused the big market meltdown of August 2015? Certainly the Fed has played a role. It showed its hand since ending quantitative easing and its intention to hike rates. Well, that was until earlier this week, in which case suddenly they seem to change their minds again. Volatility has been spectacular on markets around the world. This is the Moneymakers. I'm Bruce Whitfield. Tonight I speak to two Moneymakers that will help you traverse the complex world of money and also understand market volatility. Well, at least we hope so. We hope we've invited the right guys. First one, Vestact's Sasha Naryshkine and Gary Booysen, who's a portfolio manager at Rand Swiss. You guys love volatility. You, Gary Booysen, you watch markets minute by minute, second by second. You've got algorithms that react to markets even before you see markets. Volatility is your friend.
Yeah, definitely. I agree with that. Yeah, I was actually sitting on one of the shows here and we just saw all the stop losses kicking in. And the stop loss is an algorithm as well. And I mean, you can make a lot of money, you can lose a lot of money, but definitely in volatility, brokerages make a lot of money. So if we're looking for opportunities here, we probably should be looking at the JSE.
With lots of volatility, Sasha Naryshkine, which unnerves your clients who tend to be people of some social standing who invest for the long term. They don't like to see share portfolios lose value, do they?
Of course they do, because it's an opportunity, Bruce. You know, I was fiercely calling everyone who I knew had cash sitting on the sidelines. Say, come on, we wait for moments like these. You wait for it, because like you pointed out, you know, pick whichever one. I think the reason why this one maybe caught everyone off guard a little bit more is, and I hate to use the phrase range bound, but if you have a look at the S&P for the better part of 8.5 months, it was just trading in a very, 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 very narrow band. And that's unusual, because VIX was at what, like 10, 11,
the VIX
12?
is the volatility index, and 10
Correct.
and 12 is incredibly low volatility.
Historical
Yeah,
lows.
you sit here,
Yeah.
normally the VIX sits between what, 12 and 18. And now we got the spike. Where
To 40.
Yeah,
It
I
hit
think it
as high as
was
40.
53, I think
It
we
was
got to at one
53
stage. Like,
intraday,
which
yeah.
took you through what happened in 2011.
Isn't VIX like code for when the market falls over? Because, you know, it's not really a measure of volatility.
No, it's not, it's clearly not a measure of volatility. It is at times of panic. The
Yes,
volatility
it's a measure of
occurs
panic.
and it measures panic.
Yes.
Now, what was the difference then between this China-fueled, Fed-fueled, globally fueled micro panic that we saw in the last couple of weeks versus the considerably more serious 2008 meltdown, Gary? What gave you the confidence to go, it's just a blip?
Yeah, well, I think you never know when the bottom's going to be, and you don't know if it's going to be a systemic risk until it is a systemic risk. And I mean, but I think that's the difference between 2008 and now. You've got to look at China and say, is this really going to feed into contagion? Is this actually going to affect the real underlying economic markets? I mean, or is this just a little bit of panic, a natural sell-off in a bull market that, like Sasha says, gives the long-term clients an opportunity to accumulate?
We could sit here and we could come up with 10 Chinese companies that we know that probably are listed in China. We could sit here for the rest of the day and into the evening and wonder, do we actually know anyone who owns mainland Chinese stocks? The answer is probably no, Bruce.
No, but one questions the systemic risk posed by China.
Okay.
And I'm getting tweeted and SMS'd and emailed lots of views from people who believe they're incredibly clever. They generally write with
Bruce.
capital letters saying, warning, the crash is coming soon. And it might be. I haven't a clue.
Bruce.
Do you?
You know, Ben Carlson, who writes, I think he writes a blog called A Wealth of Common Sense. He said, if I say to you 1980s stock market, what's the single thing you remember?
1987, 22% in a single day on the JSE.
Okay, so how much did the market in the US go up over the 80s?
I can't remember.
400%.
Okay.
I think that's probably the answer that sensible investors should be looking at. So even the worst single day, 7-8 months later, it got it all back. But it's not newsworthy.
But it's incredibly hard, though, Gary, isn't it? I mean, you can have the history, you can have the knowledge, you can look back at the graphs, you look back, 1929, not those graphs, historical graphs, 1929, the Dow Jones Industrial Average fell from 400 to 40. It lost 90% of its value. There's historical precedent. It can and did happen. And there have been lots of little blips ever since. Now, if you were the guy who bought on the 20th of January, if it was the 21st of January, I forget the exact date, 16th of January, if you bought the day before the market crash started, you would have lost 90% of your money, and you wouldn't have got that back for 25 years, by which time you may be dead.
After the Second World War,
yes,
if you survived.
Yeah, and if you bought it, but again, if you look at, let's say, the 2008 crash, I mean, if you look at the period you had to exit the market, and then the period you had to re-enter the market, you've got a window of about 6 months that you have to call it accurately. I mean, and anyone that can call it accurately
wouldn't be sitting at this desk talking to you, Bruce.
Definitely.
No, we'd be
even though
on,
we love doing that.
We'd be sitting on our yacht.
Yes, exactly right.
If you enjoy yachts,
Yeah,
of course. But I mean, maybe, to answer your question as well, because I saw someone who had said for every 5% correction that there had been, and then you waited and you sold at the bottom, and you waited another 3% to be sure that the market was going back up, what would the difference be in number of dollars? And it's astonishing. It's like a third of, if you just played, I'm going to hold. It's better to invest and ignore as long as the proviso is that you own a quality business. Because even investment managers and the very best get it wrong. Warren Buffett sold Tesco. Does he think Tesco is going bust in 25 years? Maybe bricks and mortar retail, I don't know.
But there was a time where Lonman, Impala and Anglo Platinum were seen as quality businesses. And you would have bought those shares at multiples of where they trade now, and you'd still be holding on to them. Kumba, it's a great business, but the bottom's fallen out of the iron ore market.
That's exactly right, but it's not to say, it also depends on if you're talking about a stock or an index. I mean, I think Sasha's talking about a broad-based index. Yes, indices will recover.
No, you talk about stocks. If
there's a fundamental change in a stock, I mean, then yes, to get out. Of course you must get out. I mean, if you can see that that a company, I don't know, Blockbusters, would you be holding Blockbusters? I don't know. You can kind of see where the future of that was going. You probably shouldn't have held it. I don't think it's that complicated.
But let me turn it around and say Palm Pilot. You remember those funny little...
But they were the biggest innovators of the week.
Amazing. But they were, at the time, they were amazing. When people spoke about a smartphone, they spoke about a BlackBerry. Marissa Mayer, in some interview, she went, smartphones like Samsung and Apple and other phone makers like BlackBerry. She suddenly just rubbished something, and that's in a space of 2 to 3 years. So if you are going to buy a consumer-facing business, which, let's face it, every single business is a consumer-facing business.
Ultimately, yes.
Whether you make aeroplanes like Boeing, or whether you sell coffee like Starbucks. And didn't Howard Schultz at the beginning of the week send out an email saying, be kind to the frazzled stockbrokers? He sent out an email to all his baristas, partners, or whatever they call them, say, be kind. But ultimately, you want to be buying a business that you think has the legs to be able to survive through any cycle. And that isn't for everybody. Because otherwise we wouldn't have seen. Maybe I can add one little thing here to say why we saw so much volatility.
Yeah.
Because about 4 or 5 weeks back, Carl Icahn and Larry Fink of BlackRock were on a panel. And Carl Icahn pointed at Larry Fink and he said, people like you are going to cause the next crisis because of everyone's index investing. So what happens if every single retail index investor presses the button at the same time? What happens is the Starbucks share price goes from 52 to 42 in 7 minutes.
Yes.
That's the kind of thing that can happen.
Okay, so this is going to happen again. It might not happen this week or next week or the week after, but it's going to happen again, and chances are it's going to happen again before Christmas because some negative information will come out of China. How do we best prepare ourselves to ignore it in the faith that it'll be okay?
There's nothing like experience. Just go through a few. I mean, remember.
Show us your scars, Gary.
just drive a smaller car and live in the park.
No, that's it. And don't panic at the bottom. But I mean, also you can look at it, and you have to look at the fundamental reasons why the sell-off is happening. I mean, we're looking at sectors now, perhaps that you'd want to buy into in a sell-off, and you look at the reason behind the sell-off. It's a broad-based international sell-off. So you go and find the good quality companies that you don't change your investment thesis, and you pick them up at lower prices.
But suddenly, to buy, to go into the US and go and buy a stock on the S&P, or to buy the index, or to buy something on the Dow Jones Industrial Average, just costs 10% more, courtesy of the rand. And that is
at least you're not investing Russian rubles.
No, I hate people. I hate people who go, but at least you're not. I lost a finger. Well, at least you didn't lose your whole hand. It's still blimmin' sore.
You know.
But here we've got a situation where there are great opportunities present themselves in dollar terms, but now the real cost for South Africans of this little wobble is a considerably weaker currency.
Yeah, so it's not just us. I think that was the point that I'm trying to make. So if the Fed are going to continue to raise interest rates, and for the record, I think when they do reach the upper end of the trough, it's going to be a lower high, if you understand what I'm saying. It's not going to be a 6.5%, 7% cycle. It's probably going to be 3, 4. Why? Because of innovation has driven inflation lower. That is one of the main reasons why.
And what do you see? I mean, I saw David Shapiro talking about another QE program coming in now.
I don't know. Peter Lynch, who is one of the best investors of all time, said if you spend 13 minutes a year on economics, that's 10 too many.
So it's going to happen again. We agree. Will you be nervous, or will you be licking your lips with joy at the opportunities it presents when we're another 10% down from here?
Half, and maybe Gary can correct me here, half of the margin debt associated with stock trading in China has been unwound. Half.
Yeah.
I think
Sounds about right.
So I think you've seen a bottom put in. I think the Chinese authorities are desperate for the wealth effect and the good. I think you must be ready whenever there's an opportunity that presents itself.
There we go. Gary, you as optimistic? You've been very quiet.
No, as optimistic.
Commit.
I think you've got to buy the dip here. You've got to buy the dip. Keep buying as long as you've got money to do it.
So yeah, hopefully your money doesn't run out. Hopefully your money doesn't run out
Keep
before the dip
borrowing.
does.
We'll talk about CFDs and margin trading. No.
I'm absolutely terrified, and I'm going to stop them right there. Gary Booysen, Portfolio Manager at Ransmith, and Vestact's Sasha Naryshkine this evening, reflecting on what has been a tumultuous month for investors, not only on the JSE but around the globe. And yeah, the big victim of the last couple of weeks has been the South African rand, but there was a man from Citadel this week who was talking about a bounce back for the currency. We'll see whether or not he's right. Time will tell. Gary Booysen shaking his head. Maybe that's a subject for a discussion another day. There'll be more discussion on volatility, on madness, on craziness, and how to stay calm through it all next time on the Moneymakers. Good night and goodbye.